So market structure is probably the single most important topic and concept in the technical analysis module. And if you master this and you really make sure that you get this right, then I promise you that everything else will pretty much fall in line and it will be a hell of a lot easier. So you need to know what side of the market you're on, what side of the market that you should be on and what you should be looking for. And structure tells you all of that really. And like I was saying, if you don't get this right and if you don't build your foundation properly, then essentially your trading business will fall over. It's really going to struggle if you think of it that way. So anytime you go on your charts, this is pretty much the first thing that you need to be thinking about, looking at and analyzing. And then everything behind that is pretty much secondary and comes afterwards. I think, market structure is probably one of the most misunderstood concepts within trading. Structure, it just tells you everything. It tells you the best zones, the order flow, the direction, it's behind your entries. And it massively helps with getting the most out of your trade management as well. It just shows you everything you need to know. So how you view it, especially when we start to look at multi-time frame analysis, it's really going to define how well that you're going to be able to trade this stuff. Honestly, I really just can't stress the importance of it enough. If you do understand structure properly, then everything else will become easy. Basic market structure, kind of what you learned day one, right? Baby pips. What is a bullish market? Well, a bullish market is very simply defined by price making a series of higher highs and higher lows, right? So bullish order flow, you're going to keep seeing price making those higher lows. Each low is staying intact and it keeps printing a higher low. Now, every time price takes out a high to form that higher high, we get what is called a break of structure. So kind of just annotated that as boss, right? So price moves up, it forms that higher high, it pulls back to form a higher low, it then breaks that high, so we get a break of structure, that high to then form that higher high, then we pull back to form a higher low, right? Pretty basic stuff. Now, that's kind of if the market moved in a nice utopian sort of fashion, but obviously in reality, it's a little bit more complex than that. So this is a bit more of a realistic example where when price goes on, it breaks structure to form that higher high, it can have a bit more of a complex movement. So the way, or I guess the most important thing probably out of this entire video would be nailing where your swing highs and your swing lows are in structure. If you can get that right, everything else pretty much will follow from there. So let's say we're in the live market, we see this high get taken, we get a break of structure, we form a higher high. As price starts to pull back, you can then mark out where your high is and you can mark out where your most recent swing low is. Now, everything within that high, that orange line, and that low, that orange line, right? Everything in between there is just internal structure. So the whole time price is, pulling back, it's breaking highs, it's breaking lows. Price is still bullish. We're still within the swing high and the swing low. This is all just what I call internal structure. Now, when price finally breaks out through that high to form that higher high and we get that break of structure, we want to look back and we want to know where our new swing low is, okay? Now, some people would say this is their swing low. Some people would say this is their swing low. But the way we're going to do it, nice and mechanical, is a swing low is the lowest point that caused the swing high, okay? So when we see this new high being formed, and we know that's the new high, our swing low is the lowest point that caused the high, which in this case, as you can see, as I've already marked, that is the swing low, okay? Now, again, this might seem pretty basic, but as we start to apply more kind of, complex steps to this, or we start to look at multi-time frame analysis, especially in the live markets, you can sometimes get a little bit lost. So it's just really important to then nail where the next range you are playing within, okay? So then price can pull back to form that high low before we get that next break of structure. Now, the reason why this is so important is because what you'll see a lot of people do in the live market is they don't kind of paint the story well enough, they don't go back far enough in price action, and when they're trying to define their swing high and their swing low, what they do is they're actually way too zoomed in on price. If I can actually get this to zoom in for me, and let's say they're just looking at this section of price action here. And they go, okay, what I can see is price is making a series of lower lows and lower highs, and it's pulling back to form a lower low, a lower high, and now it's broken and it's formed a lower low, right? And they're just looking at this section of price action in the orange line, right? So then as price is pulling back up to this level, maybe there's a supply zone they trade from, maybe it's a resistance zone, wherever you trade, and then they try and get short from here, right? Whack on, okay, that's going to spaz out for me, but whack on their risk reward tool, and then boom, they get smashed, right, as price moves up higher, and they're sitting there scratching their head going, well, price is moving to the downside, it was making lower lows and lower highs, I've got short, I've just been spanked. Why is that happening? And they go, oh, maybe that was just, down to probability. But actually, it's because you're on the wrong side of the market and you haven't mapped your swing highs and swing lows correctly. And you're trying to trade that internal structure. And you're trying to trade against the actual swing trend there. So yeah, it's pretty basic, but you'd be surprised at how many people who have actually been trading for quite a while can get their structure mapped out a little backwards sometimes. So that's kind of the main points I wanted you guys to take away from this sort of first little bit. Swing high is just the highest point. It's vice versa on the bearish stuff, right? The swing high is the highest point. So let's say this high, that caused that low. So then when price forms that lower low in a bearish market, that becomes your next swing range. So price can pull back as deep as it wants, right? It could come all the way up to this orange line, but as long as it doesn't breach that line, as long as it doesn't form a higher high, as long as that lower high stays intact, then we're still in a bearish market and price can then go on to make that next lower low, okay? Then again, everything that's in between that low and that high, that is all just internal structure, okay? It's not swing structure. And the final point is, again, a very simple one, but after a break of structure, we always expect a pullback on that time frame. Pretty simple, but you'd be surprised at how many people in the market, let's say over here, right, they see that level go, they see that high go, they see price form a higher high, and the minute they see that level go, then they start thinking about buying. They think, okay, well, we're forming a high high, we're bullish, that's a sign of strength. Let me get in long here. But actually the smart thing to do is when you first see that break of structure, that's when you need to, in your mind, start thinking the opposite and going, well, actually, now I'm expecting a pullback. So now I need to think about that and adjust accordingly, right? Whether you want to short and play the pullback or whether you need to manage, etc., etc. So on to the next thing, very, very simple stuff here, but this is the concept of strong and weak highs and lows. So easiest way to think about this is, what is a low's job? Well, a swing low's job is to make a swing high, if you think about that, right? And a swing high's job is to try and make a lower low, okay? So lows want to make highs and highs want to make lows. Now, in a bullish market, that is where we have a series of strong lows. So the way to think about this is a strong low, this solid blue line, because it went on to form a high. It went on to form that higher high, so it did its job. Now, when price pulls back, this high where the pullback initiated from, right? If it doesn't take out that strong low, then actually that means it's a weak high because it's failed to do its job. That high has failed to make a lower low. So if you get in long here, right, you can then target that weak high, that dotted high, because it's failed to do its job. So now we get in the bullish market, we look to get long and we target that weak high, okay? Exact same thing. As long as it pulls back and it doesn't take out that next strong swing low, we now know that this is a weak high. So if we are in any longs here, we can target that weak high and then we can try and target that high there. So hopefully that makes sense. Exact same thing in a bearish market. Not going to go through that just for trying to keep this video at a reasonably short length, but that's kind of as simple as this concept is, but it's a powerful one, because if you're getting in long here on these strong higher lows and you're going, okay, where am I going to target? Well, you can start to target that weak structure. This is a weak high. Why? Because it failed to take out the low. Okay, it failed to do its job. This is a strong low in theory, right? So we should try and target that weak high, so on and so forth. So if you think about it, really our goal as traders, if we're trying to trade those easy trades, trade those continuations, our goal is to catch higher lows in a bullish market, right? We want to catch all of these strong lows and we want to catch lower highs in a bearish market, right? We want to be trading from here and then targeting those weak lows, right? That's kind of the simplest way to think about it. So like I was saying here, right, let's say we're in this bearish range here. We've had that break of structure, price is pulling back. At this point, we know that this is a strong high because it took out the low, it did its job. So in theory, price can pull all the way back up to the high, but because it's a strong lower high, price should not breach it. And kind of another way you can think about this is that it took a hell of a lot of money for price to actually move down and break that low. So I guess you could think there's a vested interest in that high being protected and price not trading above that high, right? So what that does is we can build trade ideas around that, right? It gives us a hell of a lot of confidence to look to short from here and target what? Target that weak low. Why is it a weak low? Well, because it failed to do its job. It failed to take out the high and it failed to form a higher high, right? Super simple, but it just gives you such a clean framework for kind of mapping the structure and knowing where to target. So trend changes. Obviously, bullish market doesn't last forever. Bearish market doesn't last forever. Well, especially in Forex, maybe if you trade crypto or the stocks, it's just bullish forever. But yeah, anyway, so we have a bullish market. We're making price is making higher highs and higher lows. Now, at this point here, right, this low in theory is a strong low because it did what? It took out that high and it made a higher high. So it did its job. But at some point, what's going to happen is price is going to break that low and it's going to go on to form a lower low. So when price is pulling back, we expected this to be a strong low. The expectation is that bullish trend will continue, right? So we should expect price to do that, but obviously hasn't. The bullish expectation has failed and price has now formed that lower low. So we're now in a bearish market, okay? And that's what this dotted line shows. It just shows where that trend change occurred. As soon as we break this level and we form a lower low, for me, that is now a bearish market. Now, some people, what they want to see for a confirmed trend change is they want to see both a lower low and a lower high, okay? And the reason why that is because what can happen is you can get a trend change, price can form that lower low, but it can be a false kind of signal and then price can continue upwards. And what it turns out is actually it was just a liquidity grab. It was just grabbing the liquidity behind this low to grab that and then continue the bullish market. So that's why some people, they don't confirm a trend change until you get both a lower low, so that move there, and a lower high, right? So they need to see the lower low and the lower high. And remember, we never know where that lower high is going to be until it takes out the low, okay? So for those people to have a confirmed trend change, they would need to see a double break of structure because they would need to see the lower low, price pull back to form the lower high, and then obviously it needs to break structure to form or to confirm where that lower high is. Okay, now so for me personally, I don't need that much confirmation. The way I keep my trading super simple is the moment we get that lower low, that swing lower low, that for me is a trend change. And now I'm looking for that lower high to form to continue that bearish move, okay? So when we get that lower low formed, if you think about the strong and weak highs and lows concept, what has happened? Well, a strong low was taken out. So that means a lot of money had to step in somewhere in this leg to form that lower low, right? To form that trend change. So in theory, this should now be a very strong high because it took a lot of money to cause that low. So if you think there's it's a protected high, right? There's a lot of money, has a vested interest in price now not trading higher than this high. So when we form that trend change and price is pulling back, what we can now do is build trade ideas around this, right? Because we can start to look to get short and we know that price should not really, in theory, trade higher than this level here, right? This line here. And then if we do get short in here, where do we target? Well, at minimum, we want to be targeting that weak swing low. Why is it a weak low? Well, because it failed to do its job. It failed to take out that high, right? So this is really simple stuff, but it's literally how you build just a solid foundation for your trading. And then very, very quickly, right, we get a bearish market and then eventually we'll form that higher high. A lot of money stepped in to take out that strong lower high to form that higher high. So the bearish expectation where we would have expected the lower high to form, that has now failed. We've formed a higher high. So then we can look for the pullback and we can try and catch that higher low because this strong low should be protected and we can target this weak higher high because it's failed to do its job right. And then boom, we continue that bullish market, okay? Pretty simple stuff. Now, something called change of character. I don't really like the term, it's a bit of a fancy name, but all it essentially means, it's similar to trend change, but it's not the same. So for a trend change, we're looking for the swing highs and lows to be taken out. For a change of character, it doesn't have to be swing structure, it can just be that internal structure. So there's little minor movements in between. That is what we're looking for a change of character. So it's the first sign of weakness or the first sign of strength, essentially. So imagine you just got some nice small little price movements making a series of high highs and high lows. The first time you see that high low fail and we get a lower low, that is your change of character, okay? Generally, we're applying that to the internal structure between the swing highs and the swing lows. That is what we call a change of structure. Then, of course, eventually at some point, that series of lower lows and lower highs, eventually price will break up and form that first higher high, right? And that is essentially what you call a change of character. It's basically bullish structure changing to bearish structure and vice versa. So a bit of a subtle difference to trend changes, but you'll see how we apply that now. So if you kind of look at this very basic sort of continuation, price model, whatever you want to call it, price makes a nice swing high, it pulls back to form a swing low. We then get a break of structure, so we form that higher high, okay? Now, when we get a break of structure, what do we expect? We expect a pullback on that time frame. How can we know when that pullback is about to start? Well, there's a few things we can use: supply and demand, liquidity, all these other things which we'll get into in a minute. But for this video, we just want to look at structure alone. So how can we know when that swing run is over and that pullback is about to start? Well, this is where change of character becomes really handy, where essentially this is all one swing leg up, okay? So we're now playing within this next range and we want to know, can we play that pullback, right? So if we see this minor low here get taken out and we get that first kind of, sign of weakness, that change of character where that minor low gets taken out, and we get that internal lower low. Now the internal structure is bearish, and that is in line with trading a pullback, right? So now we can trade that pullback. Now, how do we know when the pullback is finished and that higher low is likely to, have formed? We then get a bullish change of character, okay? Where that internal lower high gets taken out, we then form an internal higher high. Remember, the whole time the swing structure is still bullish. That has not changed. We're just looking at the internal structure. So everything in here is internal structure. We're just looking for that to switch from bearish to bullish. And that basically just allows us to anticipate when the pullback is starting, and then when the pullback has finished. And then when we get that internal structure to the upside, we get that change of character. Now we can look to get long and target what? Target that weak high. Why is that a weak swing high? Well, because it failed to do its job. It failed to take out that swing low. So just to keep this as simple as it needs to be, we look for those internal changes of character to help us know when this swing run has ended, when we can then start to anticipate the pullback, and then when we can anticipate that pullback has now finished, and we can anticipate that high low is formed, and we can start to target that next swing high. Hopefully that makes sense. Now, what I want to add is changes of character are not the holy grail. Obviously, they can give you false signals, and that is why you need to pair them with other confluents that we're going to look at right in the next few videos. So again, we get that swing movement up. We see that change of character, that first sign of a lower low. Okay, pullback is now starting. It stays bearish, but then we get a bullish change of character where we get that first internal higher high. Okay, maybe now this tells us that the high low is in place and we can target that higher high. Price tries to do that, but then what happens? It fails to do so, and now we get another bearish change of character, okay? Because now we've got another lower low. So the internal structure has now switched bearish again. Okay, maybe that means we're going to have a deeper pullback. So we pull back deeper, wait for a bullish change of character. Okay, now the internal structure has aligned bullish again. It's back in line with the overall swing structure. Okay, now maybe the high low is in place, and now we can get long and we can target that weak swing high, okay? So yeah, that's basically as simple as we use change of character. But obviously when we combine that with multi-time frame analysis, supply and demand, etc., that is how we can increase our strike rate of using it. Very quickly, the same applies to, if you're using this for reversals. So let's say price is bullish with the swing structure, right? Making a series of higher highs and high lows. Now, let's say we come into a really clean supply level that we like, resistance level, whatever your strategy is, and you are anticipating a trend change. So you are anticipating that bearish reversal. Now, what you can do, and the safest thing to always do, is to wait for this swing higher low. So this being the most recent swing low. You just wait for that to be broken, right? Because then once this is broken and we get a lower low, that trend change is now confirmed, okay? Now we have that confirmed bearish trend change, and you can wait for price to pull back to form that lower high. Now we can get short. That's the safest way to do it, but of course we don't have to wait for that. We can anticipate that reversal beforehand by looking at that internal change of character, right? So price takes out that minor low, that internal low. We then get that internal lower low, that change of character, wait for price to pull back, and then we can look to short and we anticipate that trend change. Okay, but of course, like anything, it's not 100% strike rate. We can get that internal change of character. We can get short, right? But then what can happen is this is still a strong low and a strong high, right? Sorry, a weak high until it's taken out. So when the market is bullish and we're trading to the upside, yes, we can get that change of character there and we can anticipate the reversal, like what we were expecting to happen over here. But there's no guarantee because this is still a strong low, right? So the odds are that this strong low is going to be protected and we're going to continue to the upside. So if you do get short and you're trying to trade that reversal, you see that change of character, but then if you see that bullish change of character again, you have to take that message from the market that actually this low is going to be protected. It's likely the higher low is now formed, and now we can target that higher high again, right, and take out that weak high. So yeah, just kind of that's how we use change of character. But you just need to know that, of course, it's not 100% of the time. Now, before we apply all of this onto the charts, one other thing we need to look at is actually, how do we map this on candlestick charts, right? Because we're not just going to be looking at line charts. So kind of two main ways you can do this. Both ways, we're always going to draw structure from the wicks of candles, okay? So wherever you draw your swing high and your swing low, we're always going to draw it from the wicks of candles. But the difference between the two types is what you need to see for a break of structure to have occurred. So for type 1, when you draw your structure from the candle, the wick of the candle, you need to see a candle close above that swing high, okay, for there to now be a high, for there to be a break of structure. Now, this is a bit more of a conservative way of mapping your structure because it's going to take a lot more money, right, to actually get price to breach that high and to stay and to maintain above that high and to close above that high. So here you can see where price spiked above it. Actually, it was just what's called a liquidity grab, right? It grabbed the orders behind that high, but it failed to close above there. So for me at that point, that would not be a higher high. That would not be a swing higher high because it didn't close above until we get this closure here. Now, the second way is type 2. This is a bit more aggressive because we map structure the same way from wicks, but we only need to see price literally just wick it for there to be a break of structure. So as you can see, this is the exact same price action, but you can see how the trend changes, a lot more quickly. It's a lot more aggressive. You get those turning points a lot sooner because as soon as price breaks that high, that then gives us our higher high. So then if we look back, where was the lowest point that caused the high? It was this point here. Okay, so that becomes your swing low. So you map that. Then price breaks that. So now we're bearish. So we're playing within this range here. But then price moves up and then it forms a higher high. So you can see how that's a lot more aggressive. It can potentially get you into trade sooner, but it can give you a lot more full signals where you're viewing liquidity grabs as trend changes, okay? So for me personally, the way that I use these, I use both, which, okay, you may be thinking, all right, give me a simple answer, but I always use both. So I use type 1 for, I'll show you here. I'm doing this little diagram, which hopefully makes this explanation a little bit more simple. So I use type 1 mapping where I want to see a candle closure for swing breaks of structure. So when I want to know if we formed a swing higher high or a swing lower low or whatever, I need to see a candle close above that higher low. So as you can see here, these are the two type 1s there and here, because they're my swing breaks of structure. I want to see a candle closure at both these points to confirm those higher highs. Now where I use type 2, so where I just want to see a wick break, I use those for the changes of character. So on the internal structure, I'm happy just to see a wick break there to know that I've had my change of character. Now I know the pullback's starting, and now I know maybe the pullback's ended and we can get that next higher high. Okay, so hopefully that makes sense.